Many of you have asked me for an update on Nike. Nike is down 66.66% over the last 5 years. It's a beautiful number, but it's been an ugly chart so far. They recently reported earnings. There's some kind of a turnaround happening, but it's not quite there yet. The stock is getting undervalued and it's yielding a 4% dividend. So I'm going to talk about Nike and let you know if I believe that this is finally the time to be buying the stock and if it's presenting a generational buying opportunity or not. So I hope you enjoy it as always. Now, I spoke about this before, but I'm going to talk about it again. The main reason why Nike has really suffered so much and the chart looks so ugly is because after 2021, we had a lot of pumped up demand from the stimulus checks and the unemployment that a lot of people collected through COVID. They have this money and they started buying new Nike shoes and they started traveling and they started spending on things that they want and they don't actually need. So a lot of companies like Nike, Estee Lauder, Elf Beauty, so many of those stocks, they believed that this demand was actually permanent, while it was just pumped up demand due to the stimulus checks that was not going to last. So they made the mistake of ramping up production to raise more inventory because there was so much demand. So inventory started climbing and climbing and climbing and climbing. Then the company realized that this is temporary. It's not actually a permanent kind of demand. So then they had to discount those shoes and they had to advertise them in a major way to get rid of the inventories. And Nike has been doing so over the last 3 to 4 years, and shareholders have suffered in a major way. But now the inventory story is much better and the CEO is trying to turn it around. Now, earnings per share was actually great, 35 cents versus 28 cents expected. Revenues was also not bad at all in my opinion. But if you look at the actual numbers, they're not really encouraging. Total revenues was down 3% on a currency neutral basis. Gross margins decreased 130 basis points. Now, the positive part is North America, which is where we have the highest margins. North America has shown steady growth of about 3%. Now, 3% might be low, but this is a region that was declining 7, 8, 10%. They turned it to break even, and now they're starting to grow again. So this is really good for Nike, and the CEO is making some progress. But the problem is China. There's a lot of messed up demand in China, and China continued to shrink, down 7% for Nike, and there's so much competition for Nike in China. Now it gets even worse because the company is guiding sales to decline 2 to 4% in the current quarter versus 1.9% by the analyst, and they expect China to decline 20% for the company. 20% is a big deal because China currently makes up 467 million of EBIT out of 2.2 billion. So about 20% of EBIT comes from China, and China is declining 20%, and they're clearly losing market share in China. So this is a big one. It's going to take them some time for them to be able to get back to break even and to be able to restore confidence. And the CEO is saying that they believe the tariff impact will start to loosen off after the first quarter of fiscal 2027. So about 2 to 3 quarters left for Nike to start, you could say, getting better in terms of gross margins and for comparables to get better. And that could actually be a catalyst for the stock to potentially move much higher. Now, unfortunately, Nike did not buy back any stock at those prices, even though the stock is down 66%. But to be honest, I don't really blame them because the company was extremely overvalued. It was trading at like 53 times earnings. And even after this entire sell-off, Nike is finally getting back to 26 times forward earnings. I mean, imagine how many companies, amazing companies, you could buy for 26 times or even below that. You could buy Google for 26 times. You could buy Meta for 18 times. You could buy Microsoft for about 21 times. Why would you buy Nike? So 26 times is still a little bit high. But again, this is a turnaround story, and earnings per share are expected to grow double digits for many years to come as they expand the net income margin again. Now, the best part about Nike is you get paid while you wait. They have a dividend. The dividend is about 3.6%. It's almost a 4% dividend, which doesn't really happen with Nike. I've never seen it happen, never imagined it would happen. The free cash flow yield is actually below the dividend yield of about 2.7%. So there are some indications that the dividend is really unsafe. But I personally believe Nike will likely maintain the dividend. It's been a dividend payer for many years. I think they will maintain it. I think they have the cash to maintain it. But free cash flow is expected to trough this year, is expected to start ramping up over the next 2 to 3 years as they got their inventory story under control, as the whole thing with tariff is getting better, and as China could potentially recover. So free cash flow is expected to recover, and that should really help Nike in a major way. And by the way, I'm using Fiscal.ai to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link down in the description. Now, for my valuation model, I'm using something simple, which is mainly the analyst estimates for the company. They're putting in negative 29% for this year, then 30%, 31%, 40%, and 11% for the next 5 years. I'm not sure if I believe those numbers, but I think those numbers are likely accurate because their net income margin is so low, and a net income margin expansion alone, about 1 to 2, 3%, it could lead to 30% earnings per share growth for the next 2 to 3 years. So I believe those numbers are likely, but we're going to assume that those numbers actually happen, okay? And we take the $4.04 and we time it by 25 times earnings, because this is where it's trading at right now. So assume no multiple expansion, no multiple contraction. I'm getting about $101 per share, excluding the dividend yield. The stock right now is trading at about $44. So based on the base to best case scenario, I'm getting about 150% upside over the next 5 years with Nike. So I believe Nike, to be honest, is not as expensive as it was. It's still expensive, of course. 25 times earnings is high. The earnings per share growth of 30-40% is high. But I think it's looking better. It's looking more and more attractive. But for me, it's not attractive enough for me to want to own it. If there's so many better alternatives, again, like Microsoft and Amazon and Google and even Nvidia trading at like 21 times earnings, there's so many opportunities in this market. So why would I go and buy Nike? Now, if we were in a bull market, we're trading at all-time high, then I would want to buy a turnaround like Nike or maybe Disney, which I think Disney is actually a better turnaround than Nike. You could look it up. But again, I see way better opportunities in this market. And that's just my opinion on Nike. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.